A common tool we use in accounting is called the account roll forward. We can use the account roll forward if we are missing a piece of information to determine what that information should be, or just to check that the numbers that we have are correct. Before we can start our account roll forward, we need to understand for each of our accounts what makes them increase or decrease. And we use this with balance sheet accounts. Okay, so let's take a couple examples. Accounts receivable, what is it? Accounts receivable is a promise to pay from our customers. What makes accounts receivable increase? Our accounts receivable goes up if we sell to customers on account. What makes our accounts receivable decrease? Well, our accounts receivable goes down when we collect cash from customers. Let's make that a little wider. Okay. Accounts payable. Accounts payable is a promise to pay our suppliers. What makes accounts payable go up? When we buy on account. And what makes it decrease? When we pay our suppliers. Inventory, what is it? It is an asset we intend to resell. What makes it increase? When we buy inventory. And what makes it decrease? When we sell inventory. Okay? Finally, equipment. Equipment is an asset we intend to use in our operations. What makes it go up? When we buy equipment. And what makes it go down? When we dispose of equipment, either through sale or if we donate it, take it to the junkyard, whatever. Okay, so now we understand what makes our accounts go up and down. Next we need to know the roll forward formula. So you take your beginning balance, you add your increases right here. We subtract our decreases right here, and that gives us our ending balance. Let's try a few examples together. The balance of accounts receivable, this is example 1, the balance of accounts receivable is $40,000 on January 31st, 2020. During the month of February, we sell $130,000 on account. The balance on February 29th, 2020 is $35,000. How much cash did we collect? Okay, so let's figure out what is what. We're talking about the month of February, right? Because we're talking about what we sold and then the balance at the end. So our beginning balance is going to be this balance on January 31st. Remember, last month's ending balance is always this month's beginning balance. Last year's ending balance is always this year's beginning balance. So our beginning balance is $40,000. Okay, I'm going to want to just format this really quick. Format, number, accounting, and we don't need zeros. Okay, sorry about that. We're back in business. Okay. Our increases, let me see. It says during the month of February, we sold $130,000 on account. When we're talking about accounts receivable, when we sell, that's an increase. So I'm going to enter $130,000. Okay. And then it says the balance on February 29th is $35,000. Remember, activity is going to be an increase or decrease. When it tells us the balance, that's going to be the beginning or ending balance. In this case, since we're talking about the month of February, $35,000 is our ending balance. Now that we have our formula, we can calculate what were the cash collections or decreases in the month of February. So we take our beginning balance plus our increases plus our increases. Oops. And then we're going to subtract our ending balance, and that gives us 135,000. So we know that we collected 135,000 in the month of February. And actually, I'm going to retype this formula right here. And this will be out on Google Docs if you guys want to look at it. So 135,000, except this should be a negative. Okay, there we go. So we know the answer. We know that our cash collections is our decreases, and we know the answer is 135,000. Okay, let's go on to example number 2. The balance of accounts payable is $20,000 on March 31st. It's telling us this is a balance. We have to decide if it's beginning or ending. It looks like our activity is taking place during the month of April. So our balance at March 31st is going to be our beginning balance. All right. And then it says that during the month of April, we paid $105,000 in cash to our suppliers for items previously purchased on account. So I'm going to go to accounts payable, and I see when we pay our suppliers, that's a decrease. So we paid our suppliers $105,000. Then it says the balance on April 30th is $50,000. Well, that sounds like my ending balance. So 30,000, or no, 50,000. So 20,000 plus what equals 150,000 plus 50,000. So that is going to be, let me see here. So it looks like the answer is once again 135,000. So if we had 20,000 and we bought 135, that would have given us 155 minus 105,000 would be 50,000. Okay. Oh, increases. The increases is what we were looking for. How much did we purchase on account? And purchasing on account is an increase to accounts payable. All right, let's look at 2 more. During the month of June, we purchased 80,000 of inventory. Okay, when we purchase inventory, that is an increase, so we know that is 80,000. And then it says, and sold 90,000 of inventory. When we sell inventory, that's a decrease. And then it says the inventory balance at June 30th was 35,000. And then it wants to know what was the balance at May 31st. So June 30th must be our ending balance, 35,000. And that's going to be, let me see, that's 35 plus 90 is 125 minus 80. So this must be a beginning balance of 40,000. Okay, because 40 plus 80 would be 120. Then we decreased it by 80. Oh, this should be 45. Here we go. 45 plus 80 is 125,000 minus 90,000 would leave us with 35,000 ending balance. All right. finally, our last example. The equipment balance as of October 31st is $1.5 million. It looks like we're talking about November, so that's going to be our beginning balance. All right, during the month of November, we purchased $3,000 worth of equipment. When we buy equipment, that's an increase. And we sold one piece of equipment that was originally purchased for $100,000. When we dispose of equipment, including selling equipment, that is a decrease. And now this math makes it easy. We're just looking for the ending balance. So 1.5 plus 300,000 is 1.8 million, minus 100,000 is going to give us an ending balance of $1.7 million. All right, that's how we do a roll forward. Again, we use these for our balance sheet accounts. We can use them for pretty much any of our balance sheet accounts. We did it in the financial statements video with the roll forward, or with the retained earnings. And this is a great little tool to have. All right, thanks everyone.